Я работаю в криптовалюте.
Hi, I'm Satoshi Nakamoto. Welcome to my news channel about cryptocurrency, where the most relevant news and promising projects will be covered.
11 chart patterns every trader should know. Whether you are a novice trader or an experienced investor, mastering chart patterns can significantly enhance your ability to analyze and interpret market movements. This is a comprehensive guide designed to equip traders with the essential knowledge needed to navigate the trading markets. In this blog post, we will explore 11 crucial chart patterns that every trader should be familiar with. From classic formations like the head and shoulders to more complex structures such as triangles and wedges, understanding these patterns is critical for identifying potential trend reversals, breakouts, and continuation signals. Let's dive in. 1. Bear-bull flag. The bear flag pattern is a technical analysis formation used by traders to identify potential downtrends in financial markets, particularly in stocks and forex. This pattern typically forms following a significant downward price movement, known as the flagpole, followed by a brief period of consolidation. This creates a flag-like shape characterized by a downward-sloping trend line, the flagpole, and a parallel trend line, the flag. Traders interpret this pattern as a sign of continuing bearish sentiment and anticipate further price declines. Once the price breaks below the flag's lower trend line, it often triggers selling pressure, leading to a resumption of the downtrend. The bull flag pattern is a popular technical analysis tool used by traders to identify potential upward price movements in financial markets, specifically in stocks, forex, and cryptocurrencies. It typically forms after a strong upward price surge, known as the flagpole, followed by a period of consolidation that creates a rectangular, flag-like shape. This consolidation phase represents a temporary pause or retracement within an uptrend, often accompanied by declining trading volume. Once the price breaks through the upper boundary of the flag on significant volume, traders anticipate a continuation of the preceding uptrend, which could potentially lead to further price appreciation. 2. Head and shoulders. The head and shoulders pattern is a widely recognized chart pattern in technical analysis, typically signaling a potential trend reversal. It consists of 3 peaks: a central peak, the head, flanked by 2 lower peaks, the shoulders. The pattern forms when an asset's price reaches a high point, pulls back, rises again to a higher peak, pulls back once more, and then fails to reach the previous high, thereby forming the second shoulder. This pattern suggests that bullish momentum is waning, indicating a possible shift toward bearish sentiment. Traders often look for confirmation signals, such as volume divergence or a breakout below the neckline, a support level formed by connecting the lows of the 2 troughs situated between the shoulders and the head. 3. Cup and handle. The cup and handle pattern is a technical analysis tool used in financial markets to identify potential bullish continuation patterns on stock price charts. It consists of 2 primary components: the cup, which resembles a rounded bottom, and the handle, which represents a shorter period of consolidation following the formation of the cup. This pattern suggests a temporary pause or price consolidation following a significant uptrend, followed by a potential continuation of that upward momentum. Traders often look for this pattern as it may signal a buying opportunity, anticipating a breakout above the resistance level of the handle. 4. Double bottom. The double bottom pattern is a key technical analysis tool used in financial markets. It typically appears on price charts and signals a potential reversal of a downtrend. Visually, it resembles the letter W, representing 2 consecutive lows at approximately the same price level, separated by a peak. This pattern suggests that selling pressure has exhausted itself and buyers are gaining strength. Once the price breaks above the peak separating the 2 lows, this confirms the pattern and often triggers a bullish trend. Traders often look for other confirming signals, such as increased trading volume, to bolster their confidence in the pattern's validity before making trading decisions. 5. Double top. The double top pattern typically forms after an asset reaches a price peak, pulls back, and then returns to a similar high before experiencing a decline. Traders recognize this pattern as 2 consecutive peaks, often resembling the letter M on a price chart. This pattern suggests that buyers are failing to push the price higher, indicating a shift in market sentiment from bullish to bearish. Traders often look for confirmation signals, such as a breakout below the pattern's neckline, to validate the reversal. Double top patterns are commonly used by traders to anticipate potential selling opportunities or to manage existing long positions. 6. Wedges. The wedge pattern is a technical analysis tool used by traders to forecast potential market reversals. Characterized by converging trend lines that slope either upward or downward, the wedge pattern indicates a period of consolidation preceding a significant breakout. Traders often distinguish between 2 types of wedge patterns: rising wedges, where the support and resistance lines slope upward, indicating a potential bearish reversal, and falling wedges, where both lines slope downward, indicating a possible bullish reversal. As the price oscillates within the narrowing range of the wedge, traders closely monitor volume and momentum indicators to glean clues regarding the direction of the impending breakout. Successfully interpreting wedge patterns can offer profitable trading opportunities by allowing traders to capitalize on trend reversals. 7. Symmetrical triangle. The symmetrical triangle pattern is a versatile technical analysis tool used by traders to identify potential trend continuations or reversals. During an uptrend, a symmetrical triangle typically forms a consolidation pattern, signaling a temporary pause before the upward momentum resumes. Traders often look for a breakout above the upper trend line as a signal to enter long positions, anticipating further upward movement. Conversely, during a downtrend, a symmetrical triangle may signal a brief respite in the downward movement before the trend resumes. Traders await a breakout below the lower trend line to open short positions, expecting the downtrend to persist. 8. Pennant. These patterns typically emerge following a strong price move, as the price temporarily consolidates within converging trend lines. These patterns resemble a small symmetrical triangle formed by converging trend lines. Pennants usually appear after a sharp price movement, indicating a temporary pause or period of consolidation before the trend resumes. Bulls and bears battle within the confines of the pennant until a breakout occurs, signaling the continuation of the preceding trend. Traders often look for an increase in volume as a breakout approaches, confirming the significance of the pattern. Although pennants provide insight into market sentiment and potential price movements, false breakouts can occur. Therefore, risk management and cautious entry strategies are crucial when trading this pattern. 9. The bump and run reversal. This pattern typically consists of 3 stages: an introductory phase, a bump phase, and a run phase. In the initial stage, prices rise gradually, signaling bullish sentiment. The bump phase is characterized by a rapid surge in prices, often accompanied by high trading volume that creates a distinct peak. This peak forms the bump of the pattern. Following the bump phase, a price correction occurs, known as the run phase. This correction typically retraces a significant portion of the gains achieved during the bump phase. Traders often look for specific criteria, such as volume patterns and the angle of the trend line, to validate the bump and run reversal pattern before making trading decisions. By recognizing this pattern at an early stage, traders can potentially capitalize on the impending trend reversal and adjust their strategies accordingly. 10. The Gartley pattern. The Gartley pattern is a powerful tool revered by traders for its predictive capabilities within financial markets. Named after its creator, H.M. Gartley, this pattern identifies potential reversal points in price action. It consists of a series of precise Fibonacci retracements and extensions, forming a shape that resembles a harmonic butterfly. Traders look for specific ratios within the pattern, such as a 61.8% retracement of the initial move, to confirm its validity. Once identified, traders can execute trades using specific entry, stop-loss, and take-profit levels. The Gartley pattern is renowned for its accuracy and is often used in conjunction with other technical indicators to enhance its effectiveness in forecasting market movements. 11. The Triple Top Reversal. The versatile triple top pattern is a significant technical analysis formation in crypto trading. It typically occurs when an asset's price peaks 3 times, failing to break through a resistance level, thereby forming 3 consecutive peaks at approximately the same price point. This pattern signals a potential trend reversal from bullish to bearish, indicating that buying pressure is becoming exhausted and sellers may be poised to take control of the market. Traders often look for confirmation signals, such as a breakout below the neckline, a support level connecting the troughs situated between the peaks. Triple top patterns are considered reliable indicators when accompanied by high trading volume, offering traders an opportunity to anticipate and capitalize on a potential downtrend. What is a chart pattern? In cryptocurrency trading, a chart pattern refers to specific formations on price charts that signal future price movements. These patterns emerge based on an asset's historical price data and are broadly categorized into bullish, bearish, and continuation patterns. Common chart patterns include head and shoulders, triangles, flags, and double tops or bottoms. Traders analyze these patterns to forecast market direction and make informed trading decisions. Understanding chart patterns involves recognizing key price levels, trend lines, and the inherent symmetry of the formations. However, it is essential to complement chart pattern analysis with other technical indicators and fundamental analysis to ensure a comprehensive market assessment and effective risk management. How to trade using patterns. Trading with patterns involves recognizing recurring formations on price charts that signal potential future price movements. However, relying exclusively on patterns can be risky. It is crucial to integrate other indicators for confirmation. When a pattern appears, wait for confirmation of a breakout to verify its validity. Implementing stop-loss orders protects against significant losses should a trade move against expectations. Equally important is setting a take-profit target to secure gains. Successful pattern trading requires patience, discipline, and a deep understanding of the market. By combining patterns with confluence indicators and risk management strategies, traders increase the likelihood of making informed and profitable decisions. Do you need chart patterns for trading? Chart patterns are not strictly mandatory for cryptocurrency trading, but they can be incredibly useful for traders seeking to identify potential price movements. While some traders rely exclusively on fundamental analysis or technical indicators, chart patterns offer visual cues that can aid in decision-making. Formations such as head and shoulders, triangles, flags, and double tops bottoms can signal potential trend reversals or continuations. Understanding these patterns allows traders to anticipate market movements and make informed trading decisions. Nevertheless, it is crucial to combine chart patterns with other analytical methods to create a comprehensive trading strategy. In a nutshell, understanding chart patterns is essential for traders to effectively navigate the complexities of trading markets. In this blog post, we explored 11 key patterns, ranging from the classic head and shoulders to bullish patterns. By mastering these patterns, traders gain valuable insights into market dynamics, enabling them to make informed decisions and capitalize on profitable opportunities with confidence and precision. Frequently asked questions. 1. Do chart patterns predict the future? Chart patterns in cryptocurrency trading can provide insight into potential future price movements based on historical price data and market psychology. While they are not a guarantee, patterns such as triangles, head and shoulders, and double tops can signal potential trends or reversals. Traders often use them in conjunction with other indicators and analysis methods to make informed decisions. However, they should be used with caution as market conditions can change rapidly. 2. Do chart patterns always work? Chart patterns in cryptocurrency trading, as in any market, are not infallible. Although they offer insight into potential price movements based on historical data, they are not guaranteed indicators. Market conditions, news events, and other factors can invalidate these patterns. Traders use them as part of a broader analysis, combining them with other tools to improve decision-making while remaining mindful of their limitations. 3. How many chart patterns are there? In cryptocurrency trading, there is a wide variety of chart patterns, ranging from simple ones, such as pennants and wedges, to more complex formations like head and shoulders, double tops, and flags. Traders utilize these patterns to analyze price movements and make informed decisions regarding the buying or selling of assets. Each pattern signals potential trends within the market. 4. Which chart pattern is the best? Determining the best chart pattern depends on various factors, including market conditions, the specific time frame, and one's personal trading style. Some traders prefer patterns like triangles for identifying trend continuations, while others favor double tops or bottoms for signaling reversals. Ultimately, it is essential to understand a variety of patterns and apply them strategically based on the specific context of each individual trade. Go for it!
Like and subscribe to the Crypto Plus channel. Modern technologies have radically changed our society, where cryptocurrency has long been the means of payment. The concentration of capital and the growth of cryptocurrency turnover around the world is already today, where scattered small banks are being replaced by cryptocurrency cross-border payments. One of the most important modern decentralized tokens is Soviet gold chervonets, SOVAUCHER, built into the system of cryptocurrency exchanges and allowing financial transactions, which is the most suitable in the system of gaining your freedom and independence. You are on the right path, comrades.